Okay, as promised, it's 12 o'clock, so we'll go ahead and get started. Hello, I'm Ursula Marinelli, the Executive Director of the Pacific Communities Health District Foundation here in Newport. It's a beautiful sunny day today. Thank you all for joining us and welcome to Year-End Giving and Potential Tax Law Changes with Julia Carlson. Today's MedTalk is presented by Skanska US Building Incorporated, a Samaritan Foundation's Pride partner. MedTalks are meant to be interactive, so please feel free to ask questions by raising your hand with the hand icon at the top of your screen or by typing into the chat. If you're on the phone, you'll just have to verbally ask your question when there's a break in the conversation. And if you're not speaking, please remember to stay on mute. Okay, good. So now I'll introduce our presenter. Julia Carlson is the founder and CEO of Financial Freedom Wealth Management Group. She founded the firm at the turn of the century, and with its successes, she's become a thought leader in the financial industry. Julia is an entrepreneur, a speaker, author, educator, and expert on the investment landscape. She's recognized as being especially knowledgeable on topics relating to tax strategies for retirement and distribution planning, as well as exit planning for business owners. Julia has been identified as an Investment News 2020 Woman to Watch honoree. She's also recognized as one of Forbes 2018 through 2020 Top Women Wealth Advisors, as well as the 2018 to 2021 Top Wealth Advisor Mom by Working Mother Magazine and Shook Research. In addition, Julia shares her knowledge through a financial column in our local newspaper, the News Times. She actively participates in her community as a member of the Rotary Club of Newport and Chamber of Commerce. And I'm proud to say that she's the Vice President of the Pacific Communities Health District Foundation Board of Trustees. Julia lives here in Waldport with her husband and 3 children. So now I will turn it over to Julia.
Thank you, Ursula. That was a wonderful introduction. Today we're going to talk about some year-end tax strategies. We're also going to talk about tax planning and how taxes work in general. And then we're also going to talk about some potential changes that are coming our way. If, there's a big if here, the Build Back America Act is put into place. And then we're also going to share some charitable giving strategies that you can take advantage of here before the year end. I will also would love to say, please ask questions. We encourage participation. There are no stupid questions. And chances are, if you have the question, someone else on this call has the question as well. So, feel free to interrupt me and ask away. I will be having a Q&A time at the end as well. So if we don't get to it during, we can do that at the end. I would also encourage you to write notes. So as I go through this, maybe if something is piquing your interest, maybe answering some questions, how does this impact me? What do I need to change? What do I need to do between now and year end? What do I need to worry about? And how does this impact you or maybe a loved one, a parent, a nonprofit you love, all of that. Samaritan Foundations and our local hospital has a very special place in my heart. About 10 years ago now, my parents and daughter were in a hit head on by a drunk driver and all needed to go to the hospital, and my daughter ultimately life flighted up to Portland, and they were taken care of in the best way by our local hospital system. And so for me, giving back to the foundation and which is supporting our rural health is really important. And so as we talk about these charitable strategies, this is one foundation that we give to, and I would encourage everyone on the call to think about that as well. I don't really need to go over this because Ursula introduced us. So I will say that Financial Freedom Wealth Management Group, which is my company, we have offices all over Oregon. So in Corvallis, Eugene, Salem, Portland, and here on the coast in Newport. Here's part of my awesome team. And so let's dive in. So let's first talk about our tax system. So in the US, we have a progressive tax system. And that just means people with higher taxable income pay a higher percentage of federal tax. And so in this chart on the left is the single. So if you were single filer, that shows you the top of each of the income tax brackets. And so, for example, if you're a single making under $86,000, then you would be considered in the 22% tax bracket. But you don't pay 22% on all of your money, just it graduates as you go up the scale there. And then on the right-hand side is a married filing jointly tax brackets, and in the middle there are the tax rates. And so if you are a married filing jointly couple making $150,000, then you would be falling into that 22% tax bracket. This is important to understand what your tax bracket is, because when we start doing planning, we want to know if you want to go up to the top of that 12% tax bracket, then you want to know what that number is. So $81,050. So feel free to take a screenshot of this, and it will also be available afterwards to review as well. Now in 2017, there were tax cuts that happened. And during those tax cuts, you can see it shifted from the column there on the left to the right. And so most of us got about a 3% tax break after 2017. Now, currently, if no tax law changes happen, that is set to sunset in 2025 and go back to where we were in 2017. So if you're in the 12% now, you'll most likely go back to the 15% in 2025. Capital gains tax is did not change with the tax law changes, and there are three different percentages on capital gains. So you're either in the 0% tax bracket, which means, going back to that chart I shared, if you are in the 10% or 12% tax bracket and you have capital gains, your tax rate is 0. Once you go over that 12%, so once you jump from 22% to 12% to 22%, you jump into that 15% capital gains. If you are in the state of Oregon, it's also an additional 9%. And then if you're in the highest income tax bracket, then you jump to 20% on capital gains. So capital gains are taxes that are due if you sell an asset and have capital appreciation. So this would be, for example, a stock that maybe you bought a stock at $10,000 and now you're selling it at $20,000. If you've held that for over 12 months, then you get capital gains tax treatment instead of ordinary income tax treatment. And that is advantageous. I also would like to note, if you have dividends from stocks, so those are what's called qualified dividends. Qualified dividends are subject to these capital gains rate taxes, not ordinary income tax rates. Okay, I'm throwing a lot at you. And so if you have questions about all that, we're going to keep going, but it's a little confusing, but I hope this kind of sets the foundation for what we're going to talk about. Now, in 2017, when the tax laws changed, they increased our standard deduction. So prior to 2017, a lot of us itemized our deductions, which allowed us to deduct charitable contributions. When they increased the standard deduction, I think the figure is as much as 80 or 90% of Americans now do not itemize taxes. And so essentially it feels like you don't get a deduction for charitable contributions. So if you're a single filer, it's $12,550 for 2021. If you're married filing jointly, it's $25,100. And please note, when you look at your tax rate, that first chart I showed, that is based on taxable income. And that's after you take the standard deduction. So for example, if it's a married filing jointly couple, their income's $100,000, they would take the deduction of $25,100, and then their taxable income is $75,000, which would put them into that 12% tax bracket. Okay, so let's shift a little bit into now, how do estate taxes work? So at death, your assets are totaled for calculating your total estate worth. And anything over the federal and state exemption, which I'll share here in a second, is taxed at estate tax rates. Estate tax rates are very different than the ordinary income tax rates that I shared for us. So we'll look at those together. They're a lot higher. And then retirement accounts, unless it's a Roth IRA, are always taxable at death to the beneficiaries. And the only caveat to that is unless it's going into a charitable institution. So if you list a beneficiary or you list a nonprofit as the beneficiary, obviously the nonprofit would not pay taxes on that. But this is really important to know because the retirement account is added into your total estate worth, and it's also taxed when it comes out. So it could be double taxed depending on the size of your estate. The current federal estate tax exemption is $11.7 million. So what that means is federally, if I die, my estate is 11.5 million, there would be no federal taxes due. So that is a pretty big number. You know, most Americans don't have $11 million. And so there's not a lot of federal estate tax collected right now. Part of what is in this Build Back America plan is to reduce the federal state exemption back to around 5 million, which is what it was before they increased it in 2017, I believe. So the opportunity we have in 2021 is a use it or lose it opportunity. So which means if you do have a larger estate, you can gift assets now and you don't pay taxes. You do have to file what's called a gift tax return, but there's no taxes owed to either you or the participant. It's just saying, hey, I'm using my exemption while I'm living. And you can do that. You can do that moving forward as well. So it's a way to do a bigger gift. A lot of times when we do exit planning for business owners, we're using this, which reduces the taxes. Oregon state exemption is only $1 million. So a lot of Americans have estates, which is their real estate and retirement accounts, of over $1 million. So that's pretty average that seniors as they die, there is usually organ tax that is due. Now, between couples, there's some planning that can happen. So you ensure that each couple or each partner gets the $1 million. Because if no planning is done, if one partner dies, all of those assets move over to the other partner. And now they've lost, and that happens without taxes. But what's happened is they lose that $1 million exemption because now all the assets are in the other partner. And then when they die, they don't get 2 million, they only get 1 million. So it's important, if your estate is 1 to 2 million as a couple, that it's important to start looking at estate or estate planning to reduce potential taxes. So back to the example, if I died with 11.5 million, I would not owe, well, I wouldn't owe it. My husband wouldn't owe taxes on federal, but he would owe taxes on, this would be, hold on, it doesn't happen between spouses. It happens it happens at the second, if you're single, if I was single, and let's say it goes to my kids. This is a better example because couples, they get to go back and forth. If you die, everything goes to your spouse and there's no taxes due. It happens when the couple dies. And so if my kids, they would be paying taxes between 11.5 million and 1 million. So 10.5 million would be subject to organ taxes in that scenario. Okay, so let's talk about estate and trust tax rates. So this is you can see how quickly you get in higher income tax brackets with estate and trust. So if your taxable income for an estate and trust is over $2,650, you're in the 10% tax, 10% bracket. It jumps then to 24%. And then if you're over $13,050, which is not very much, it jumps to 37%. So as you can see, in estates and trusts, the tax rate goes high very quickly. So it's really important that the planning is done to avoid paying taxes at those rates. So here are some tips for charitable planning. Name your favorite nonprofits as beneficiary on your traditional IRA accounts. So the reason why is the nonprofit will not pay taxes on that when they receive those funds. If you leave them to your spouse or the kids, they will always pay taxes on ordinary income tax rates on those retirement accounts. The only exception is Roth IRAs. Roth IRAs, because you inherit them tax-free. By nature, they are tax-free as long as you follow all the rules. That's a great asset to leave to your kids, to your spouse, to your family. Name your family as beneficiary if you could have a trust account or a non-retirement investment account. These could be just stocks and bonds that you own in an investment account. Currently, there is what's called a step-up cost basis at your death. So if you bought a stock for $10 a share and you die and it's worth $100 a share, your beneficiaries will receive that and their cost basis in the stock will be $100 a share. So when they go to sell it, as long as your overall estate is not over the exemption limits, there would be no taxes due to your beneficiaries. And so again, as a recap, the best place to do your giving is out of retirement accounts. So your IRA, a 401k, a 403b, That's a very great way to ensure that you're just reducing overall tax liability. Okay, so this has come up. This is always a popular time of the year to do tax planning, and it's been fun to actually see a lot of activity around people wanting to give appreciated assets to their favorite nonprofit. I just had a conversation yesterday, actually, where a nonprofit was receiving appreciated or stock from a donor. And the advantage of doing that over cash is that you personally are not paying the capital gains when you sell the investment. So, for example, if I wanted to give money to the Samaritan Foundation and I wanted to give $10,000, I could either write a check for $10,000, and that would be a deduction, but I could also give shares in a stock that I've owned for 20 years and have appreciation in that stock. And by doing that, I still get the tax deduction, but I also avoid the capital gains tax of selling that investment on my own. And I also want to say, if you have grandkids or kids that are going to pay for college or need money, I would also encourage you to think about it in the same way. Gifting to kids or somebody that you would ordinarily write a check for, you giving them shares, they sell the investment. Most likely they may be in a lower tax bracket, especially if it's a child. Then they would sell it and pay taxes at their rate instead of at your rate. So it works both ways. You can also think about real estate. Could be something that you have appreciated value that you can gift real estate. You could, we've seen it now in the world of cryptocurrency, we've seen giving of that. So it's not just writing a check. There could be lots of ways to get money or value to the nonprofit. So each year, all of us have an amount that we can give to someone else without using up part of our lifetime exemption amount. And that is $15,000. So that should, 2021 is 15,000. It's the same as 2020. And what's nice about this is if it's two partners or two spouses, they could each give $15,000 to a child. So, for example, if my husband and I, we have 3 kids, we could each give $15,000 to each child, which would be 15, 30, 45. So a total of 90,000 total that we could give to our kids. So we could do that each year and not use up that lifetime exemption amount. So as your estate is growing, especially over $1 million in the state of Oregon, what I've seen is a gifting strategy where parents they would start gifting that to children. This obviously does not apply to nonprofits. We'll talk about that in a second, but this is just to another person. There is no taxes due on either side. So we don't pay taxes giving, and the recipient does not pay taxes receiving. So the CARES Act came out in 2020 as a result of the pandemic. And for 2020 as well as 2021, it allows for charitable contributions of cash up to 100% of your adjusted gross income for both of these years. That's increased from typically you're limited to 60% of your adjusted gross income. It was also increased for corporations. So corporations can now deduct up to 25% of their taxable income. And this was increased from the 10%, which is the ordinary amount. Now, here's a fun little tip. Maybe if you filed your taxes last year, you saw what I call above the line deduction for charitable gifts made in cash up to $300. So on the top page of your 1040, all of us could deduct $300 last year. If say $300 for single and married, but this year it's increased to $600. So even if you take the standard deduction, you can still give $600 and take that as a deduction for 2021. So that is something that is special to the CARES Act. Most likely that will go away and not be available in future years.
Julia, there's a question about retirement gifting. So I'd like to ask that question before you go on.
Sure,
so
go ahead.
Do you do this annual gifting after retirement, or do you recommend gifting once you hit that $1 million ceiling?
Well, I kind of think about it, it's like the masks that come in the airplane. It's like you have to take care of yourself first, then you can take care of others. So you really want to think about, okay, are you financially independent? Like, are you on track for your retirement? Is everything solid in your financial future? And then if so, then you can do the gifting in any years. You don't have to be retirement age for any of the strategies that I've talked about. Does that make sense?
It does to me.
Okay. Well, we can clarify at the end.
Yeah. Mary gave the thumbs up. We're good. Okay.
Okay, great. Okay, so let's transition. That's a great segue into, this is special for anyone over 70 and a half that has an individual retirement account, a qualified retirement account that you are forced to start taking required minimum distributions. Currently now it's at age 72. So a couple years ago, they raised the age from 70 and a half to 72, where you have to start taking money out of your IRAs. This does not apply to Roth IRAs, only traditional or pre-tax IRAs. This was established so that essentially the IRS has given us a tax break each year for putting money into these retirement plans. And they're saying, hey, at some point, we need to get that tax money back, and you have to start taking money out at currently 72. But what they have made permanent, which is really cool, I think, is what's called qualified charitable distributions. So when you turn 70 and a half, you can take $100,000 a year. That is the maximum, any amount up to that point. And you can give that directly from your IRA to your favorite nonprofit. The benefit of that is it's not reported as taxable income on your tax return. It just goes from your IRA to your charitable organization of choice. So that's a lot of our clients take advantage of this. We actually set up a checking account for their IRA, so they can actually write checks from their IRA directly to their nonprofit. And when the standard deduction was raised, I think that's when these became very popular because again, it just stays off your tax return completely. So really great strategy to consider for your required minimum distributions, which come into play at 72. Okay, there's another charitable strategy that I want to discuss, and it is called a donor advised fund. Now, donor advised funds, they were established, I think the way that I kind of think about it is if you have a year where you have a one-off big taxable event. So for example, it could be selling a business, it could be selling a piece of investment real estate, it could be taking profits on a stock position. A lot of different scenarios come up. And instead of doing a big contribution to a nonprofit all in one year, you would actually kind of set up your own little donor advice fund. So once you contribute the money to the donor advice fund that you would establish, it's a deduction at that point. Now there are limitations. You are able to donate up to 60% of your adjusted gross income in cash, or 30% if it's like a stock or appreciated asset. So it's not 100% of AGI, but it is still considerably bigger amounts that you could do. Now, once it's in the donor advice funds, it's left your estate. So if you die, it's not included in your taxable estate. But the neat thing about it is each year, or whatever cadence you decide, the donor advice fund can move money to nonprofits that you choose. And they don't all have to be the same. Could be the local food pantry, could be Samaritan, could be the Red Cross. You can change it up. You can fund, you can send 10,000 one year and 5,000 the next year. So it's very flexible. But the nice thing about this is it's creating this fund that you're giving out of. And so the deduction only happens when you fund the donor advice fund. So that's important to understand. It's not every year when you're making these. It's just the one time when you're putting money into the donor advice fund. But where I've seen this neat is where, like, if parents establish a donor advice fund and then they bring the whole family along to start understanding their legacy. Like, okay, mom and dad want to give back to Samaritan, or they want to give back to the food pantry, or it's a way to start showing what's important to you and getting your family involved. So I've had grandparents where they have the grandkids decide on a nonprofit that gets the money. So again, it's just bringing that next generation along and starting to, sow into them the core values of who they are and what's important to the family. So neat little tool that I think where this comes in is if you have a bigger one-off event that is creating higher taxes. The deadline is around the 15th of December to get these set up. So if something happened in 2021, it's time to look at that if that seems like a right fit for you. Okay, so let's talk about this Build Back America. Now, there is lots of media about this right now. I give it a, let's see, 40% chance, maybe 30% chance of the more I hear about it, of passing by year end. I think they have other, they have to fund the government, they have to deal with the debt ceiling. So there's a lot of other priorities, but this is definitely a priority that they're trying to look at. So some of the provisions in this, I think as Oregonians, I think this is important for us. There would be an actual increase to the SALT. So SALT stands for state and local taxes. So currently, when you itemize or you look at your itemized deductions, it's capped at $10,000 in the state of Oregon. So someone like for us, we have our home property taxes. My husband and I both work, so we pay state taxes. We're very easy getting to that $10,000 and going way over it that we cannot deduct anymore. And so it would be raised to $80,000 as the new cap for salt. So for Oregonians, that's a positive. They're also talking about a 15% minimum tax on profits of large corporations. Now, this would be imposed on profits of corporations that report over 1 billion in profits to shareholders. So publicly traded companies. I will say originally they wanted to raise corporate profits to 28%, which that has all gone away, meaning I don't think we're going to see an increase in corporations in a large degree, which is beneficial for, helping this. I think that would be a headwind for stocks. And so now that that's off the table, when that got off the table, the stocks went up, and now this new COVID variant is kind of wreaking havoc in the markets again. All right, another one is high income surcharge. Now this would be if your AGI was over $10 million, this is who it would impact. So again, not a lot of Americans. And it's interesting because it introduces a new type of tax. So we don't have a tax like this, like a surcharge tax. So if that does get introduced, it's interesting because now it's starting to bring in another level of taxes. What part of the infrastructure bill was a big investment in electric vehicles, charging stations, and then this bill would bring back those tax credits for if we buy an electric vehicle, a tax credit of up to $8,500, which is pretty big. And then lastly, retirement plans. So what they're trying to avoid is millions of dollars inside retirement plans. So if your retirement plan is over $10 million, again, for most of us, that's not an issue. But if you have over $10 million, or if you have private investments, like you own a company in a retirement plan, a private company, there's some limitations there that they will shut down IRAs. And then I think the other biggest thing around retirement plans is they're eliminating what we call a backdoor Roth IRA. So if you're at a certain income level, over about 180,000 for single filers, about double that for married filing jointly, you actually can't put money into a Roth IRA directly. So there's a way to put money into a non-deductible IRA and then immediately convert that over to a Roth. That would be eliminated. So Roth conversions essentially would be eliminated for higher income earners. So 2021 is a great year to think about Roth conversions. Now, obviously, when you convert money from a regular IRA to a Roth IRA, there are taxes owed. So it's really important you understand, does it make sense for you, which we can help with that. But there's a window of opportunity here where it could be good to take advantage of this year. So we won't know. I mean, I think we'll know in the next 2 weeks before the government shuts down for the rest of the year whether this will get through or not. But the chances. I was listening to all of the the talk about it this morning, and the debate was not looking good. So I don't know what's going to happen with that.
So, Julia, we have another question. It's from a person who is still working, and her partner is working as well. Last year, they owed quite a bit in taxes, and so they're looking for some strategies to reduce their taxes for this year. She says that they have a son who's in college, and he has some college debt, and would paying some of his tuition debt help to reduce their taxes for 2021? And if not, do you have any other suggestions for people who are currently working but are looking for tax reduction strategies?
Yeah, unfortunately, paying the debt directly yes, helps your son, but doesn't give you a tax break. Let's see. I would, number one, want to make sure that you are maximizing your contributions into your retirement plan at work. If you're self-employed, you know, consider looking at small business retirement plans that you can set up. Now it's hard because we're coming to the end of the year, but some companies actually allow their bonus, like you could actually opt your bonus into the 401k or the retirement plan. So that would be something you could look into. Traditional IRAs, again, based on your income. So I would say the other option, which I'll get to here, is we do free free review of your tax return. So if you want us to like look at your tax return to kind of understand what's happening, then we can point out if there's any opportunities where you can save money in taxes. So I would offer that. So if you want a complimentary consultation, if you want like help one-on-one, you know, about anything I've discussed today, you can text the word GIVE on your smartphone to 458-777-4458. And we can either review your taxes, schedule a review, talk about any strategies. I also want to mention, actually, let me put these two disclosure pages up, and then I'll talk about the Samaritan Planning for Your Legacy resource. So my company is partnered with LPL Financial. That is our broker dealer. So I just have to just put that out here. This is the compliance side of what I do. And then here's some more disclosures about the SIPC insurance. And obviously everything I've talked about is not specific advice for you. It's important to talk to, you know, whether it's us one-on-one about your situation or your CPA, you know, someone that can really help understand your situation and do these strategies apply to you. Okay, so let me go back to this screen and then I'll share. So Samaritan has, I didn't get into a lot of like estate planning, wills, trusts, all of that, but there's a resource. It's called Planning Your Legacy. And this is from Samaritan, and it has great resources about getting you to start think about what you need to have in order for when you die. And you can do it as a couple, you can do it individually, but it would probably take you an hour or two to go through, but there's also some really good education in there around wills and trusts, and it's just a really good start. So if you want that, you could go ahead and text the GIVE, and that way we'll actually send you a link to get that information off the website. So you don't have to schedule the complimentary consultation just to get this resource. And then also we do have our 2021 tax guide coming out. It's like going to be going to the presses, I think, tomorrow. So that's also something that will tell you all about deadlines. It goes over the tax rates that I reviewed, all the things that was in this webinar. Okay. Thank you all. That was a lot.
Thank you, Julia. You know, I had a couple of quick questions as you were going through. You had said that the estate tax would be over, you know, those amounts would be 37%. Was that federal or Oregon or both?
Good question. That is only federal. So yeah. Oregon would be 9% on top of that. So you're almost at 50%. Now, I do want to, this is often a question. If you have a living trust, like my husband and I have C&J Family Trust, and we're the trustees, we fall under the personal income tax rates and brackets. So it's only when a trust carries on after we die. That's what would fall under that. So meaning if my husband and I died, the assets would stay in the trust, And because there's not it's not like a real person anymore, it's its own entity, that's when it falls under those tax rates.
Mhm. Okay. And then with a donor advised fund, is there a minimum amount to set one up? And who would you go to set one up?
Yeah, good question. So, usually I like to say around 100,000 is where you want to be with those, because there is some administration costs. Like you do have to upkeep it and understand what's happening. We set them up for clients. The Oregon Community Foundation, I think it's called. They set them up. So there's several institutions that will set them up and administer them. But usually you want to have at least 100,000 to make it kind of worth it.
Right. Does anybody else have any questions?
Hi, Julia. Thank you for that. And my question is related to the step-up basis that you were talking about. I thought I had read that might be going away. And I previously had been under the impression that it might really only be for people of, a high wealth. Can you talk a little bit more about that?
Yeah, it was in like the very early revisions, but that has gone away, to my understanding. Yeah. So I think that would impact the average American. Yeah, I see it all the time where someone dies and they have stock or they have a home that they've lived in for 40 years. Like that impacts a lot of us. And I think these tax increases, they're trying to target, the people that aren't paying their due share, right? That have all these fancy planning techniques. They're multimillionaires and escaping the average, the tax rate. We all have an effective tax rate, which is what we're all paying, and that should be similar, across the board.
Right. Well, if you do have other questions for her, or want to talk to her about, your specific situation, go ahead and send that text. I also included my email in the chat. So if you wanted to just email me directly with a question about giving to one of the foundations, I would make sure that was forwarded on to the appropriate foundation to answer your question. So I also wanted to let you know that in the next week or so, you're going to be receiving a link that has a survey about today's Med Talk and also a recording of today's presentation. So we'd love to hear your feedback, and feel free to share that recording. And yeah, so everyone have a wonderful day, have a wonderful holiday, and we'll see you at the next one. Thank you. Thank you, Julie.
Bye, everyone.